All right, today we're going to tackle a term you hear all the time in the news, the IPO, or initial public offering. This is that huge moment when a private company steps out onto the world's biggest financial stage, and we're going to break down exactly what that means. You've definitely seen the headlines, right? Some hot new tech company is going public. But what is actually happening behind the scenes? What does it mean for the people who started the company? And more importantly, what does it mean for you as a potential investor? Let's get into it. So here's what we're going to cover. First, the absolute basics, what an IPO is and why a company would even want to do one. Then we'll walk through the whole process, step by step. After that, we'll look at what happens on launch day. And finally, we'll see how it all looks from an investor's point of view. Okay, let's dive right in. Section 1. What is an IPO, really? Well, an initial public offering is pretty much exactly what it sounds like. It is the very first time a private company sells shares of itself, its stock, to the general public. You can think of it like this. A company that was once a private club, owned by just a handful of founders and early investors, is now opening its doors and letting anyone buy a piece. So that brings up a big question. Why would a company want to do this? Why trade that private, exclusive status for the public spotlight? I mean, going public is a massive, expensive, and super stressful process. The reasons have to be really, really good. It really comes down to this massive trade-off. The biggest upside? Money. Lots of it. An IPO can raise an absolutely staggering amount of cash for growth, for new projects, all without taking on more debt. Plus, it's often the huge payday that early investors and founders have been waiting for. But the downside is serious. The company is now under a microscope. You've got intense public scrutiny, strict new reporting rules, and a flood of new legal and accounting bills to pay. All right, so let's say a company weighs all this and decides, yep, we're doing it, we're going public. This isn't just a simple decision. It's the beginning of a long, pretty complicated, and very highly regulated journey. So, how does it actually happen? It's definitely not as simple as just flipping a switch, that's for sure. The whole process involves a cast of high finance players, and they all have to follow a very specific script. Okay, so first things first, they hire an investment bank to act as an underwriter. This bank is basically their guide for the whole trip. They help figure out the right price for the stock and manage the sale. Often, that main bank will team up with other banks to form a syndicate, which just helps spread out the work and the risk. Then comes the prospectus. This is a huge, detailed document with everything you could possibly want to know about the company. Finally, the underwriters go out and get commitments from big players like pension funds and other large investors to buy the shares before they ever hit the market. And this is a really important point to get. The IPO itself is that first sale to the big guys, to the large institutions. It's not the moment you or I can log into our brokerage app and start buying. That part comes next. Okay, so once those initial shares are sold to the institutions, the stage is set for the main event, the part that you always see on the news. And then you hear that opening bell. This is the moment everyone's been waiting for. The company's stock is about to be traded by the public for the very first time. So on launch day, the stock finally hits an exchange like the New York Stock Exchange or the Nasdaq, and the whole game changes. The price is no longer set by bankers in a boardroom. It's now driven purely by supply and demand from the public. This is why you often see that massive flurry of buying and selling right at the beginning. All that pent-up excitement is finally hitting the open market. So that's the story from the company's point of view. But let's flip this around. What does all of this mean for you, for the average person who might want to invest? What are the real risks and opportunities here? This really is the million-dollar question, isn't it? We all hear these stories about getting in on the ground floor of the next huge company, but how realistic is that for the average investor? Well, the hard truth is, it's really, really difficult. Buying shares at that initial IPO price is almost impossible for most of us. Those shares are usually reserved for the investment bank's biggest and most important clients. For most of us regular investors, our first real chance to buy is when the stock starts trading on the exchange, and by then, the price could be very different. And yeah, jumping in on day one comes with its own unique set of risks. There's no public trading history you can look at to see how the stock behaves. Sometimes the company itself is pretty young, so there isn't a ton of financial info available. You can see some wild price swings in those first few days and weeks. And you have to remember, some companies go public because they're strong and growing, while others might be doing it just to raise cash to stay afloat.
So it really boils down to this classic dilemma, right? The chance of losing a lot of money is absolutely real. But on the other hand, the potential to make a significant profit is also there. And that's what gets everyone so excited. It's the ultimate high risk, high reward scenario. So when you look at an IPO as an investor, what is it really? Is it a calculated risk that you've taken after doing tons of research on a company's future? Or is it more like a shot in the dark, a bet that you might catch lightning in a bottle? Ultimately, the answer really depends on the company, the state of the market, and how much homework you're willing to do.